how do you finance a construction project? In today's episode, we have Darren Dimarco here, who's a business development manager at Penn Financial, a local credit union in the Niagara region. And he's going to share some of the projects he's been able to help finance, which include, anywhere from constructing a single family home all the way to, helping subdivisions get built, and many different details along the way that may help you if you are interested in sort of the construction financing space. And we also talk a little bit about his experience sort of in the Niagara region and some of the details about Penn Financial as well. Stay tuned for that.
But what you do every day is almost the exact opposite. You want to minimize risk in everything you do. So why don't you tell us a little bit about what you do, maybe why you got into it, and then maybe we kind of get into some fun stories.
Okay. So my role at Penn Financial is a commercial account manager. So I deal with any type of business. It could be, a manufacturer making widgets. It could be just someone who wants to buy a duplex. You name it, any type of business income that falls under if it's in a corporation, if it's business income, it falls under the commercial umbrella. So you guys as realtors typically deal more with, you can be a commercial realtor, but you guys typically deal with the personal use, your home, your personal residence. Me, it more, as soon as it's a business outside of your personal use, it's for business income, comes to commercial, and that's how we figure out what comes to me. Now,
If I'm a personal individual and I'm buying, say, a sixplex, am I coming to you or?
You are. So our policy, now it could be different usually it's 5 doors. Anything more than 5 rental units in a property goes to commercial. So 6 doors, you got 6 rental units, a sixplex like you're saying, that comes to commercial. The main difference between that is higher prices. So it's a little more involved. So commercial banking, there's always, at least for our processes, we do an annual review each year. So we get your financial statements, we get confirmation that your property taxes are up to date, a new rent roll saying, your sixplex is, here are the new rents, you're still making money. We go through the full process. It's almost like rewriting the loan application. We go through the process. Yeah, everything looks good. On to the next year, push it out another year. And every year we do the same process. So because of that, there's a little more eyes on you. Commercial lending is typically riskier. If you own something in a corporation,
your personal liability.
Mind you, most people are personally guaranteeing their loans, but yes, theoretically there's a separate, like that extra layer of separation. So yeah, and just to get into more of what I'm looking at from a day-to-day perspective, it is primarily real estate, rental properties, construction loans, land development loans for residential, mixed-use, commercial, that type of purpose. But it's also, it could be a business that they need a line of credit for their business for, cash. Let's just say they have a bunch of receivables and accounts receivables, they need financing to help, before those get paid off. So anyways, it can be a whole whack of different things, but for the most part, it is primarily real estate financing.
And do you deal with also like CMHC insured financing?
So CMHC insured financing is typically, it's changing. It is in commercial now. We are not a CMHC designated lender for the commercial side. So we're starting to see a lot more. It's actually really competitive. We're having a harder time winning mortgages that fall under that CMHC umbrella, where if you have a rental property with, say, 20 rental units, the CMHC will essentially guarantee the loan. And anyways, you get some really crazy good rates.
Yeah.
And if you can fall under that CMHC band umbrella, the rates are very low. I've seen 50-year amortizations on some. So things that we can't do because we're not getting our loans guaranteed by the government. So, but yes, we're seeing more and more of that for sure.
So,
in the commercial space.
To give an idea, so if someone were to come to you with like a sixplex, right? Mm-hmm. So I'm thinking of a client that we have. He has a sixplex in St. Catharines. Mm-hmm. It's probably worth 1.2 right now. 6 units, fully rented out, right? For that type of property, do you know roughly what the terms are?
So yeah, no, that's a good question. We typically have a guideline of residential properties. We can finance up to 75%. So it's a little more equity when it's a commercial property like this. 75% is the maximum loan to value, but your loan has to be supported by the rental income that it produces. So that rental property, let's just say, produces 110, that rental property wouldn't, but let's just say it produced $110,000 of net income EBITDA at the end of the year. Our loan payments for that year have to be $100,000. So you need to see income as 1.1 times as much as your loan payment. Your debt service ratio, we do for residential a 1.1 times debt service ratio, and that typically determines the loan amount more than just saying, oh, it's a residential property, 75% loan to value, here you go. We have to make sure that the income from the property can support the mortgage payments.
And do you find in practice, does that limit the
Yes,
loan?
yes. Especially older properties with longer term tenants. Now, mind you, you would get a bit of a discount on the price when you're purchasing it if it does have, longer term tenants. So it helps a bit in that sense. But yes, it's tricky. Financing rental properties when you have, it's one thing when you're dealing with your personal income. If we could take into personal income into account and change, we don't. It is completely separate. Your personal income is one thing. This business is treated based solely on the income of this property. So there are ways around it. There are some, what you can do is you can get a corporate guarantee from, say you have another business, you have this rental property, but we also have this business that builds homes and it produces all this extra income from this operating business here. So then you can get the corporate guarantee from this business. You can help use the income from that to help support your loan application for this rental property that wouldn't typically be able to get up to that 75%.
Okay, interesting.
But you're able to use the income from a separate business.
So like theoretically here, like I'm a realtor, my business is incorporated.
Mm-hmm.
Like I'm incorporated, whatever.
Right.
Then I've got, say, another corporation that I buy rental properties with. Say I've got a property that, maybe my DSR is like 1.05.
Correct.
Instead of 1.1. But I, do really well as a realtor, and there's considerably excess money being added to the corporate account there. Will that kind of help offset that, or does it need to be more of a business that's within that same industry, or how does that kind of work?
For you, no, because it's. I'm just kidding. But
Ryan Dick on the blacklist of Penn Financial.
for you, no. But everyone else, yeah, it's. Well, no, I mean, like, it's hard to say. Honestly, there's so many different variables that get taken into account, but there has to be some proven income from that source, like you're saying in that case, your professional corp, you have income there. Case by case,
similarly,
but
like a doctor or a lawyer who has a professional corporation, would that be kind of down the same line there as well?
Yeah, their loans, like they can. Okay, so there's a program called if you're an owner occupied, say you're a dentist or you're a doctor, you can get financing to purchase a property where it's 100% loan to value. You don't put a dime into it.
For your business.
For your business. So if it's owner occupied, and like other businesses too, and I'm not just saying professionals, you can get financing up to 100% where you don't have to put a dime into it. But again, your income from your business is supporting this loan. So there's a little bit, like, that's the scenario I'm talking about.
I've heard the servicing on that can be quite expensive though, right? Like just the monthly cost, because you are financing 100%. Like, do you know what the amortization is?
Hey, if you didn't need me, ideal scenario, you don't have to pay interest for sure. Everyone ideally doesn't need a mortgage, right? Then I wouldn't have a job, I guess. But yeah, you're right. Like, especially with the prime rate, with the Bank of Canada's rate being elevated where it is now, you're gonna pay a higher interest rate for sure. If we were talking 3-4 years ago, there were some, the loans were dirt cheap.
What type of premium are you paying, I guess, above what, like, say, a residential mortgage rate is?
So residential mortgage, we treat, I don't want to give all the secrets away, but no one's watching this, right? Typically, we charge an extra 50 basis points on top of our residential rates. So if your standard mortgage was 5% for your personal use property, we're going to charge 5.5% interest on a commercial
Really?
rental property.
That's
That's
not
like
bad,
a rough.
actually.
That's a rough,
Yeah.
and that's I think most.
Even for like a sixplex or something like that?
Yeah, I mean that's our policy. Like I'm sure there's some. Again, like we're a lot smaller than say what the banks would do. If you have a really preferred member, let's say with a bank or wherever, someone who's got tons of business, a huge wealth portfolio, maybe they're going at the same rates as a personal residential rates.
Well, I heard the opposite. I'm hearing that the commercial rate can be quite a bit higher than the residential rate.
Yes. Oh, for sure. Like again, this is one case. A residential rental property is probably your lowest risk of all the commercial loans that could. Because like one thing I always find people get hung up on is you keep hearing in the news where it's like, oh, commercial real estate is having such a hard time in the United States. What they're talking about is office buildings in the United States are having a really rough go. Office space here, not a whole lot of appetite here to finance office buildings. I'll be honest. That's not we're not really looking to get into that space a whole lot because it's, anyways, but that is one segment of what could be considered commercial real estate. So I like, maybe we have a small section of our exposures to office space, but most of it would be rental properties where rents are sky high. And, so the risk right now for a commercial book is relatively low unless you're overexposed to office space. That is where you're seeing the most pain, especially in the States. It sounds like I've heard of some of the deals going on right now for office buildings. Like it's crazy. And I have heard here in Canada too, as well. Some of the banks are basically saying and this is banks, again, they probably have a lot more exposure in downtown Toronto with office space. Yeah. That's starting to really, leases turn over and companies aren't leasing back at the same square footage. They're taking 15%. Right? 50% of those workers are now working from home. So anyways, a lot of the banks have maybe more exposure and they're saying, we're going to pull back from that space. So you typically see this at times, like during COVID, you couldn't get a loan to buy a hotel if your life depended. Like you had to be the strongest of borrowers on the face of the earth. But times change. Now all of a sudden the market rebounds and now suddenly, that hotel doesn't look so bad anymore. And the people who did buy during COVID, heck, they got one whack of a deal, I tell you. So go ahead.
I was going to say, so like who's your kind of the ideal person that you work with? Because obviously, like if somebody's doing purpose building a sixplex, they're probably not coming to you because they're going to go to the CMHC, right?
Well, I would say CMHC is probably bigger than a sixplex, but
okay. I'm just thinking of somebody that we know personally.
Who
does that,
Thank
which
you.
is why I brought it up. But.
Yeah, that's a good point. So our bread and butter, I would say, is our construction lending program. Do we keep it when the construction's done on let's say I'm going to say a 20 unit apartment building. Let's just say because six can be tough for the CMHC lending. It's too small, I think, for what that program. There's a lot more rules. Anyways, let's say for a 20 unit building, that's our sweet spot. Like those $3 to $5 million construction loans, we are more flexible than banks don't really do any. Well, I shouldn't say they don't do any, but banks don't do a whole lot of construction lending in this, especially in Niagara. It's not a lot of rental properties get financed. The construction gets financed by a credit union, and then the banks take it out at the end. Or we'll win deals too as well at the end when it's what's called the takeout loan. So you do the construction piece. At the end, you get all your leases in. The property, can support this mortgage. We then put the mortgage for 25 years on the building, and yada yada yada. So typically, if you can get that, and what we're seeing more is we finance, the credit union finances the construction, and then CMHC is coming in with the takeout financing afterwards. We get paid out. It's not ideal. I wouldn't have to work as hard if I could win those takeout financing at the end.
Then you keep the loan with you for
Construction
right?
is tough. Like construction it's a constant grind because every time let's say you're financing, a subdivision, put all this money out the door, and then as services get put in, and now you got all this big subdivision, each lot sells, And as each lot sells, you get paid out. So you put on this big loan and then you get paid out quick as well. Like, so you're always having to replace that loan. You always need a deal to replace it. 2023 was a trickier year for construction. Not a lot of builders had any starts, especially for single family. And you notice real quick when your loans that you already had on get paid down and nothing's to replace it, you're kind of, it can be tricky. So yeah, and that's, but anyways, to go back to it, I think our main, where we fit really well in the market is we can do construction loans. We're more flexible. Banks and, some of the bigger credit unions, we'll say, they have a little more structure and you need to fill this, you got to fit in this box. Being smaller, we can typically take, a case-by-case example and say, well, you don't perfectly fit in that box, but you mitigate this risk because of this or that. And, so that's where we fit in the space. I would say we're kind of like a niche lender. I would say for construction loans, we deal with Penn Financial. For how small we are, we're not big. We probably have just under $1 billion of assets under management. And we deal with all the, a lot of the bigger, builders in this area in Niagara. And a lot of it is because we're easy to deal with. That being flexible is a huge, huge, huge selling feature to a lot of developers.
How did Penn Financial come about?
Penn Financial started as, now, mind you, it's an amalgamation of a number of different smaller credit unions in Niagara that have formed into one credit union now, but it started in the head office in Welland on East Main Street.
Really?
Yes, yeah, I love Penn Financial. I'm a Welland boy, you know that. So I drive 5 minutes to work. It's great. I love it. So anyways, that building there on East Main Street used to be what was called the Atlas Credit Union. So back in the day, it started as all the employees of the Atlas Steel formed a credit union. And then over time, it's amalgamated with Cataract Savings and Niagara Falls, the Fort Erie Credit Union, and slowly Dunville. Anyways, so slowly but surely, and we've opened a new branch in Fawn Hill. So there's a bunch of different branches that now form Penn Financial that, over time have been gobbled up to become what we are now. And actually, I'll mention it now too while we're on the topic. Penn Financial is amalgamating with another credit union called Main Street Credit Union in 2025, assuming everything goes through. So it's being smaller credit union, typically, it makes more sense, I think, to get bigger. You have more economies of scale as you grow. It's financially, it makes sense to grow in that manner, and it will keep happening with smaller credit unions. The number of credit unions in Ontario is gradually declining year after year. I don't think there's new credit unions just popping up out of nowhere.
And credit unions, correct me if I'm wrong, the structure is that they're owned by the depositors?
The members. So if you're a member, you're a part owner, let's say.
And you get paid as an owner in cheaper services or something to that effect?
Not entirely. Like
that sounds nice. Sounds really good though.
No, well, okay, so a bank makes their profit each quarter. TD Bank produces $4 billion worth of profit each quarter, let's say, and then part of that profit they pay out in a dividend to their shareholders. So someone from around the world, whoever it is,
whoever owns TD stock,
yeah, you get paid your dividend each. We don't have that same structure where we don't have shareholders in the same way. You're a part owner, but we don't typically pay out our profits because what happens is you need that profit to grow. So how it works is it's a very regulated industry. So your retained earnings, which is just years and years of net income growing over the time, that's what determines how much we can lend. You have to, it's like on a property, how we're talking about how a 75% loan to value on your property, that means you have to have 3 times debt to your 1 time equity, 3-to-1 debt ratio. It's the same for us. In order for us to grow our loans, we have to have a certain amount of equity in the credit union to be able to grow and offer more loans. So, yeah, I know what you're saying.
Let me try to understand this though. So you have an organization that's owned by its members that is profitable, that doesn't pay the profits out.
Well, I mean, you could say that our fees are lower than.
Okay, so the goal isn't to maximize profit. So you're giving your members some benefits.
Yeah.
But at the same time, it's retaining earnings that's compounding because you're lending it out there. Your loan book's growing.
Yeah.
So over time, doesn't this become a very valuable entity, but without necessarily a person getting it? But
well, you wouldn't get any benefit from. You don't get paid a dividend by banking with TD Bank.
No, of course,
right? Like it's not like.
Well, I'm
we're
just trying to think.
different
Isn't all of this value in a organization and
So it's a cooperative.
yeah?
So the cooperative mindset is that you're yeah, go ahead.
I'll say, so like me as a member, it's benefiting me for you guys to grow because you'll be able to service me better with larger loans. Right. And like I understand the regulation side of things because especially if you look back in like 2008 financial crisis, particularly in the US,
right,
or recently with SVB, like you need to have so many deposits in order to lend out money because that just makes sense, right? So as the credit union's growing, they can potentially better serve their members or better serve the community because they now have more ability to lend out financial.
I totally agree. And the other thing I always say that's the main, I'm a big support local guy. That's my, Ryan will attest
100%.
to it.
Guy only drinks Black Sheep coffee and Bridgewater beer. So yeah,
I'm a big supporter of my local economy. I think by supporting your local credit union. So take Penn Financial, for example, our head office is in Welland. It's in Niagara. We have all of our suppliers. Let's say we contract out for marketing. Say we have contracts for whatever certain services that Penn Financial uses. It's all Niagara based. We're not like if you're in Toronto. I not to say there's anything wrong with that. It's if you're out in Toronto, but I do like that my profits and all the business expenses go towards local businesses as well. So, and I like having, I like to know that there's a head office that's supporting jobs in this area as well. Not to take anything away from the banks. Again, that if your head office is in Toronto and that's how your model works, that's what works for you. But I do like...
Now, there's something to it, right? Because if you think about if you have a mortgage, you're paying interest every month. Mm-hmm. If you have it with a big bank, it's just going to
a shareholder from
shareholder, but also it's like most of RBC's employees are in downtown Toronto, downtown Vancouver. Mm-hmm. Like yes, they have some employees in Niagara, but it's like a shell of what it is in the larger cities. But
it's true.
Like a credit union, it's paying like employees, office space.
Our office space is paying local property taxes. Everything is more.
There's something to that, right? Like if you care about the place you live in, and if the organizations you can work with bring that money back into the same area, right? So
our branding is truly local banking, and I think that there's something to that.
Yeah.
It is like I said, there's.
Well,
go ahead.
I was gonna say, like, even the people that are like you're spending your money in Welland,
right?
Primarily, right? And like whoever's the CEO of Penn Financial might not be in Welland, but they're spending it locally in the Niagara region for sure, right? Whereas like the CEO of TD is probably spending their money in Scottsdale and everywhere else in the world,
flying around.
Right.
I mean, I don't blame them.
I don't blame them either. But like, as somebody who's going to go, if I want to go bank at my local TD branch, I can realize that the fees that I'm paying at Penn Financial, because you're paying fees wherever you go.
Yes, you're going to pay.
At least they're being reinvested back into my community, both with their employees, both with your business taxes and all that kind of other stuff, right?
Exactly. So, and now the whole gets a little harder to call yourself truly local so we're merging with Main Street Credit Union, but now we're just truly local in Niagara and now Southwest Ontario as well. So we'll keep that brand. We'll still keep that same. The head office in Welland is not going anywhere. We're going to have multiple locations for a while.
What other options are there that are going to be more local than that? Like that's an honest, like I know Meridian, but they're way bigger than that.
Yeah.
As another credit union, any big 5 bank or big 6 bank, like
There's
not even close to local.
No.
They all have stuff in the States and
Right.
everywhere else too, right? So
Yeah, and you make a good point about all the employees. Like, there's a lot of behind the scenes administration and, you know, like whatever it is, there's a lot of behind the scenes that you don't realize that goes into making a credit union or a bank run. And all of those employees are right here. They're getting paid good salaries here in Niagara. And that money obviously gets spent at your local business. So yeah, I think there's definitely a benefit to your local community for
That
sure.
actually even has a benefit to the customer, right? Because I remember, so that client, when he bought that Six Flags, bought it with a residential loan from RBC that allowed him to go up to 6 units, but they gave him a 50% loan to value. And the reason for that is they're like, yeah, this is out of our major metro areas. St. Catharines is
Really?
out of their major metro areas. So they're like,
that's our major metro area.
That hurt, man. I was just saying that hurt, man.
yeah. So they gave him 50%, and they're like, yeah.
This is yeah, like I said about the construction. Not a lot of appetite for construction and from the banks in Niagara. Like it's
Because
a
they're
little
not
too
going to
far
know
away.
like which side of the street
And
is
you
the
need to
place
know
you
that.
need.
You need to have that expertise. I 100% understand why they don't do it here, and they'll focus more of their attention in downtown Toronto. I totally get it. You got to know, you got to live and breathe that area in that space where you're operating, or else you're gonna make bad loans. And I understand it. Like,
I mean, theoretically, like you'd go and do like site visits. And
Correct.
You meet your members, you meet the people who are holding them, or you're holding the mortgage, but the mortgagees or whatever. You're going out and meeting those people, maybe yearly, maybe every other year.
Yep.
Like, you think RBC's ever been to that Sixplex in the last few years?
they would have I'd have to imagine they do have a commercial team in Niagara for sure. Like there's I know people there. Like it's definitely a thing, but it's definitely the smaller you go, that's where it gets trickier. So a Sixplex is not big enough. You're almost at a certain point, you're too small to get that, like that sweet spot is you got to be a certain size. And like,
Well, even with the CMHC financing, the one thing I found out recently is they have a minimum of at least $1 million. If your loan is not $1 million, it's too small, right?
And I get it, but also there's a lot of boxes to check for those loans, and there's a lot of administration that goes along too, and it'll be little things that you're getting the construction financing from, let's say, Penn Financial. We're saying, for a project this size, it does not make sense to, let's say, get this report, this study done. Let's just say,
Yeah. Well, you need to know what to get before you start the construction and the renovations, right? Because
for sure.
if you don't know what you need at the end,
Right.
you can't have got it done along the way, right?
Exactly. So anyways, we might have something that we don't require, but then because they're painting with one brush or whatever it's saying, you have to end up fitting a box for a loan that typically would, you have to get something for a loan that would only apply to a loan of a certain size, but because you're small, you're now having to get it, which it would never make sense if you were actually that size. So anyways, it is I've always said, like, small business departments of local credit unions, I'll even say I worked at Meridian. Meridian has a great small business program. We have, I deal with a lot of small business owners as well. And like, that I think you only really get, and you're a small business member at Meridian, Ryan, I know. Like it's, and like I worked there previously. Like Penn Financial, what we do here with dealing with the smaller guys, I think it's a perfect, like, you need that. We fit a good part of the market that you just would not get service if you didn't have that type of lender in the space. So we absolutely need, a few credit unions in every region like this. It's a good fit, I think.
Is Penn Financial primarily a lender, or do they take deposits, checking accounts, credit cards, all of that?
I think, it's not just loans, of course. We have to have deposits to fund those loans.
To fund the
as well.
loans, yeah. Okay.
And of course, the checking accounts and credit cards, electronic payments, EFT, AFT. You have to offer everything in order to compete in those spaces as well. So of course, small, big, you know, in today's day and age, you have to offer all of the banking services that everyone else is offering, and that is something that I hope by growing and, you know, the merger with Main Street Credit Union, I hope that only makes us better as we have a bigger budget for our tech and our online services. I think it can only get better as you have a bigger budget for those types of things. So I'm actually really optimistic about the merger going through and, you know, seeing what can come of it. It's just more opportunities, more budget to, you know, get into new spaces where we didn't usually by being bigger. I think it will help. Hopefully we don't lose our local touch, of course, but I think we can do it. I love it. So.
All right, well, it's getting close to cocktail hour here, so we're gonna have.
How long have we been here?
Let's get into a couple things. Like obviously, you must have dealt with a lot of. You've told us you dealt with a lot of different small businesses and things like that. You got any kind of like interesting stories? Maybe like either really cool projects that you've dealt with that you can talk about, or maybe like things that you've seen that kind of went south, or some interesting stories that way. Do you have anything you can kind of share with us here without, you know, divulging too much?
Yeah, for sure. And like I said, I would consider myself a small business advisor who also can advance $14 million land development loans and construction. Like it's a weird role I fit in. Just being like, it is bizarre.
You're a weird guy. It's a weird role. Exactly. It all works. Eh?
I'm meeting with a guy earlier this week, and I have a commitment letter, so our loan agreement. And I'm like, this is, you know, it's a $450,000 construction loan for, you know, he's building a single family home. And I'm like, it's funny, you know, I was just dealing with a member like all last week for a $14 million land development loan. And it's like, it's nice doing both. I think you appreciate the small guys, they really appreciate all of the work, and the bigger guys. Everyone, you need a good banker. You know, it's important to every business, especially land development. But anyways, it's crazy what the disparity and the difference in what we see. But I guess I would say that actually the guy I met with on Monday, he had a little bit of a cautionary tale to say. We financed a flip for him. It was very low risk on our side. I'll be honest. He owned the property free and clear. He just needed a construction loan to help him renovate the property and then sell it. Bought the property at the peak. Took a lot longer to get the building permit for the renovation than he thought. The market did not do well during that period.
Did not help him.
Did not help him at all. And he goes, like, the amount of pain, I felt so bad for everything that was going on. And like, it's one of those things where you just, this is business. He did not do well on this one. Let's just say he lost some money on this flip here. I talking to him. He's like, Darren, it was bad. But you know what? He had a good mindset about it. He's like, I just have to remember the flip I did before that. And suddenly I don't get so down on myself. You know, leading up to that COVID run up in prices in 2020, you know, he bought a property in, let's say, 2019 and he flipped. And that one he made, like, it made made this one not feel so bad. Let's just say that. You have your good moments when the real estate market does well. Anyways, with the flipping and those types of loans, you gotta, it's tough. It's not just the market goes up and to the right all the time. There are your moments where you have to have the equity in the property. You have to be able to get through those times.
It's a cautionary tale about investing in something that has a gun to your head at the end.
Yes.
Right? You need to sell a flip.
Yes.
Because it's not a property you're going to keep. And we've
Yes.
had clients in the same boat. They've had to take a loss. And the clients of ours who've invested for long-term rentals,
Right.
even though they are experiencing similar pains, cash flows getting squeezed, property values come down, they don't have the gun to their head. They're
Right.
just riding it out, right?
You're right. Like that project where there's a set timeline where your profit is paid at the end. Rental property, hopefully you're making money throughout the years. Those construction projects, you gotta be quick. You gotta get in and out and hope the market doesn't take a nosedive while you're in that investment. So yeah, and I will say another thing too is construction financing. A lot of people don't. You don't really. If you don't deal with it, you wouldn't really know. But our construction loans are much higher interest rates than your standard rental property. You'd be looking at them like, and this is just the market. It's like 9% for a construction loan right now. It's not cheap.
And what's the loan to value on?
If it's, you know.
What's the?
Oh, well, okay. So I would say it depends on what you're doing, but you know, land, you're looking at a 50% maximum loan to value. Commercial properties where it has commercial units, 65. You know, you can go up higher again. Like there's cases, and then residential 75. But
This is on the construction loan
this would be
after it's
after
done.
the fact.
Okay. What about
but
in the
construction, like it is really hard to finance a project to build a for rent apartment building.
Okay, like a purpose-built rental.
Purpose-built rentals are actually crazy how much equity you need to have into it in order to make the numbers work, especially at today's interest rates. Like you're not getting, we have to make sure when we decide how much our construction loan is, we have to make sure that when the property is finished, built, that the rents from that building have to be able to support that 1.1 times DSR. So I've financed an 18-unit apartment building last year, and I think the loan to value at the end of it was, or loan to cost. So the cost to build it, the loan amount that we had was like 50 to 60%. So you got to think, if it's 18 units, you start doing the numbers, like that's millions of dollars of equity you need. Now, can CMHC, where it's government backed, can they get higher interest? Can they get a higher loan to cost in that scenario? Of course, they're able to do 50-year amortizations, you know, rock bottom interest rates. So obviously they can get that loan amount during the construction phase, they can get a higher amount. So, but again, there's pros and cons to that program as well. So, but yeah, I've always say it's not financing a condo different. You have an end user who's buying the property at the end of each unit. There's an out. There's a very clear out. You have all these sale agreements. That's all from our perspective. This is a short-term loan where we're financing the construction, and at the end of 2 years, 3 years, 4 years, whatever it is, we get paid out and on to the next. So it's a little less. It's construction financing is fun. I love it. I think that's my favorite part of the job for sure.
Cool. Any other fun things you can tell us about?
Let's see.
What's the biggest project you worked on?
Land development for, let's say, subdivision financing. So if we're financing the servicing of subdivisions, I don't want to get as soon as I start talking about anything specific, I'm like, I don't want to give away who it is exactly. But there's some there's just some people out there in the world that you're just looking like, wow, that asset you own is just. Some of the members I deal with, they're all, let's say, kind of like my father's age, and I always think, I'm like, man, why couldn't my dad have owned all this land out here? And why aren't you my dad? Nothing against my dad, but hey.
Hey, that guy probably wasn't fixing up your first house, though, either, in COVID, right? So you've got some pros and cons there.
No, I'm really lucky. I got a good dad. He was, yeah, I can't complain, but I will complain actually and say I could be a lot. I wouldn't have to work as hard, that's for sure, if I had a father like that.
Damn it, Dad! Why didn't you buy some farmland outside of Welland?
Honestly, you could have just buy land. Everyone.
Yeah.
They're not making more of it, as Mark Twain said.
Yeah, it's one of those things, and it makes you think like, oh, maybe where's the next land opportunity here in, let's say, Niagara.
I mean, Ryan, you had a client that had like a wild story, right?
Yes, yeah. So it's not my client, but it's one of my mom's clients.
Oh no, the other one.
Oh,
Multiple. Well, the guy who you sold the property we met on, you sold that property for him.
oh yeah, that guy.
So he had bought a property in like
So, yeah,
94.
Yeah, he bought a property in 94, right on, it's like a 10-acre property right on the corner of an unopened road allowance.
Okay.
So he bought it in 94. So that's 30 years ago. And now all of a sudden, they've moved the urban boundary and they're opening up that road allowance. So that's
By the way, that whole area, this is between Welland and Fonthill, bunch of wetland. And there's like one 10-acre parcel that conveniently does
Isn't
not
wetland.
fall into any wetland.
and we're not talking 10x here. We are talking much more.
Oh, I can imagine.
Much more.
Yeah,
Than that.
that I will say that Quaker Road belt, all that farmland around Quaker Road. I don't think it's going to look like that in 10 years. I would love to see.
It's going to be interesting.
It's going to be really interesting.
On that side of it, it's going to be interesting because it's very residential, right? You look at some of these areas that are being built up right now, as I'm sure you're aware, there's a lot of residential housing being put there. But when you put in that much residential housing, there's going to be that many more people coming, which means we need to have services for them too. Yeah. And I don't know, like you may have actually a much better, much better perspective on it. But like, do you see enough financing in terms of the commercial side and for the services that are going to be needed related to the residential thing? Or you think we're maybe a bit too heavy on the resi side?
I'll say I'm not an expert in the municipal services. So the city of Welland, let's say, for that development, has to make sure that they have the pump stations for all of the, sending out clean water, and they have to have the ability to then take in the wastewater. They have to have all of that municipal services that go behind the scenes, again, that you never think about, but all of that matters when you start planning for your development. The city has to make huge investments into that years in advance to make sure that those developments can even happen. So when I look at, let's say someone came to me with a bunch of land and said, hey, I think, I'm going to get permits to build a subdivision here. I'm going to get all my approvals in place. So I'm going to build this wonderful subdivision here. One thing that we always ask is, or that we have to look into is this land, is this area developable? Is the city have the infrastructure to support this? And if they don't, it's not to say it will never happen. It just means the timeline for development stretches out. So everything, everything is in a way developable. It's just, it might cost you more, it might take you longer. That all goes into our lending to land is typically your highest risk lending that we'll do. Just because at the end of the day, it's just a piece of dirt. It doesn't generate any income. It really, sure, you can farm it, but that's not covering the mortgage. Remember we talked about debt service ratio?
Not even close.
Not quite.
This $8.8 million 10-acre land is not producing that much revenue.
Not a whole lot. And like from our perspective, we want to see that your land, if we're financing land, we want to know that there's an out in 2 to 3 years max. That doesn't always happen, but let's just say we want to see.
There has to be a plan. Right?
There has to be a plan that within 2 to 3 years there's an out. We don't want to get stuck in projects into perpetuity, or else it can get messy. Land, and like I said, land, it really is.
Well, the value of land is based on its use. So if during this 2-3 year process they find out they can't do what they wanted to do, now all of a sudden your 50% loan to value, maybe 100%.
Yeah, right. Like it has a lot more variability of asset without any real income generation is the first to go in a bad market. You're not a great time to buy. Don't get me wrong.
By the way, though, I think that is true in general. But for whatever reason, what I experienced when I was selling my building lots, serviced or services at the road, like I was able to sell them for not much less than what they would have sold for in some of the better times. Even though like the homes on that same street had declined more.
Yeah, like your percentage, right? Like
percentage-wise.
Say homes decreased by 20%, your land only decreased by 10% or something like that.
Yeah, something to that. I was surprised, right?
Yeah, that could have something to do with like the lack of supply, right? It's
Of
building lots,
Yeah,
maybe. Yeah.
That makes.
Also, I think the people buying land, I sold early into the crash.
Right.
I think that first land sale, they were still flush with cash from maybe some sales at the peak.
For sure.
Right? And they're like cash purchase, or they're like very optimistic.
Yeah.
You have a year or two to use up some of those funds, then it's like
shoot. Maybe we overpaid there. Yeah. No, you're right. I don't think land has taken
the bigger ones though, I think like the bigger parcels I think would be more effective.
Variability for sure. Yeah. Like there's not I think what I've noticed, especially in the last year, it feels like we're not, a lot of starts. So they keep talking about, and you hear a lot in the news about starts for new units, for new homes
Yeah.
are up in 2023. Okay. For purpose-built rentals, it's up a lot. For single-family homes, so subdivisions and that nature, that's down quite a bit.
Oh,
So
interesting.
yeah, so like the units that we are building right now, it's more leaning towards apartment buildings
Ah,
and single-family home building lots. Builders aren't starting projects until they get pre-sales. That's just we don't finance the construction. We will. We not say we won't, but we want to see there's a number of pre-sales, especially for the bigger projects.
Yeah.
You want to build,
You know, 2,500 home subdivision. We want to see that you got some
Exactly.
things sold before you start. Nice.
Exactly. So you need to have those end users signed up, ready to buy in order for the financing to come in place. If those buyers aren't coming to the table, it just means you're not starting the next
phase.
project. So I kind of I have a feeling that we're going to see an appreciation in those building lots just because for those single family homes, because I don't think we're building to the amount that the market wants. I think, like, don't get me wrong, we need units for sure in the apartment buildings, but I think there's a lot of families that still want single family homes. I don't think that's going away. And if we don't build them at the speed that we need them.
Well, just to your point on that, I know there's a subdivision in Welland in the south side, which is a rather large subdivision, and I know that the homes in there right now that are basically 1 year old, so they were purchased pre-construction, likely by an investor or by a buyer. They then rented them out for a year or whatever, and now they're going off and reselling them. Those homes are being sold for around $100,000 less than they were bought pre-construction. So if I'm a builder in that subdivision, let's say I've built 1/8 or 1/6 of the subdivision, and I sold off the first 1/8 or 1/6 of that subdivision, first phase of the subdivision, at $1 million or $900,000, and now those homes are being sold resale at $900,000 or $800,000. It's gonna be very hard for me to pre-sell new pre-construction sales at prices that are above what a resale is going for right there, right? So that's going to significantly, like, if I'm the builder, I'm going to be like, I'm pumping the brakes. I'm going to slow down because I'm like,
especially if you have equity in that deal.
Yeah.
You own the land. You're like, why am I going to build something and sell it for less? Let me wait until it's better.
Until it's better, right?
Right.
So my question to you earlier, though, I'd like to get I'd like to get a little more clarity on it. So you're obviously financing development. We're talking about residential development right now. What I was kind of getting at earlier was that my anecdotal qualitative analysis here is that it seems to me like we're doing a considerable amount more of residential development, and we're not doing enough commercial development to support the residential development. Are you seeing that on, like, when you're doing these loans? Like, are you financing a lot of projects that are for commercial services?
Plazas.
Yeah, like plazas, retail spaces, different things like that. Like, are you seeing, like, because there's obviously got to be a ratio there. I don't know what that perfect ratio is, but do you think we're in the right ratio there? Or do you think we're slacking on the commercial side?
I would say, like you're saying, a commercial,
whether it's a
lease,
retail
like commercial,
plaza,
yeah.
doctors, like, because when we bring in people, you need doctors,
Yeah,
you
for
need
sure.
shopping, like, you need those things to support them, right?
Yes, for sure. It does feel like it's, and I wouldn't have the numbers to back it up by any means, but it does feel like the commercial units and, if you're trying to lease up just a little business on a downtown, like, it does feel like those units are getting leased up quicker than even some of them residential. I do feel like those commercial units, if they're renovated, if they're nice, they're getting leased out. Those are moving a lot faster than, you're right. I think there is something to be said about, we do need to keep up with the commercial. On the commercial side, for those types of units, I do think they plan that out when they're building, say, a subdivision here, subdivision there. They want to make sure there's enough employment lands when they permit it.
Okay.
So there is, I don't think the planners are completely taking a stab at me.
No,
Like,
I'm sure the planners aren't, but I mean more from, like, the appetite from the, like, obviously if you're a developer, you're investing.
Yeah.
Right. So I'm thinking more of, like, the appetite from the investor side of things.
Right.
So, like, if I'm a big money investor, like a big developer, I'm trying to build in all these homes. I feel like there's an over appetite for developing residential lands,
Right.
as opposed to the same type of, net worth individual or whatever, or
Trying to build a
company
commercial.
trying to build the commercial
Yeah.
spaces to support those residential
Yeah,
lands. And I could be totally wrong.
no,
This
you're
is just
not wrong.
me kind of like seeing like stuff like that, right?
And I will say, it does feel like the new commercial buildings that have popped up, there does not feel like there's much vacancy. Like an older unit
buildings
that
are
needs
different,
some
but
work, definitely different story, but
Class A, newer buildings.
Class A is really strong, I think. And I would say you're right. There's like businesses are still going strong. I don't think there's a
Well,
huge
at the end of the day, all
downtick.
those people that are coming here have to.
They have to shop somewhere, yeah.
They got to eat. They got to go to doctor's office.
Yeah.
Just full grocery delivery.
You're-
buy my shoes there.
But you're
everything,
bringing up
right?
another interesting point is that banks and credit unions also very aggressive on medical buildings. Like there's
Okay.
some programs, kind of like how I was saying, if you're owner occupied, you can get 100% financing, something crazy, that type of thing. But on the medical center space as well, there's a good appetite from lenders. And I think it makes total sense. Like you said, your business case checks out. More people here, they need the services. They're not just gonna like you gotta grow with the amount of population growth as well.
We can't just say our city grows by 10,000 people.
Yeah.
We can't have zero growth in terms of the businesses that go along with those
100%.
people, right? Like, it
And
just doesn't make sense.
demographics is playing into the fact that it's an older population. As we're getting older, as the boomers get to that age, they need more medical services. So
Yeah.
there's a good runway of time where that will definitely be a demographic trend that I would say you're probably going to do well. And I do feel like there is a lot more push for those medical centers that are coming up. And yeah, definitely from a banker's perspective, we like them. It makes sense though, right? There's going to be a need for it in the coming years for sure. I don't see it going away anytime soon. So
Yeah.
I think we should
it.
wrap it there.
I just got one question. We should definitely wrap it. So you've been great.
we talk so much.
You've been great.
I saw you yesterday.
You've been great with your New Year's resolutions, as you said.
Yeah.
So what's your New Year's resolution for this year?
Oh.
What are you doing for us?
I already hit it. Oh, I already did it. I told you. I'm the go.
I said low expectations.
You already hit it. What is it? Can you share with us?
Of course. Of course.
what
I'm
are
an
you
open
doing?
book, Ryan. You know me.
What are you doing?
You already know it. So I set my. Did you know? Are you setting this up and pretending like you don't know? Maybe. All right. Look at these all for the show. Eh? So I set my New Year's resolution was I wanted to join a board of directors somewhere, and already got it. I shouldn't say I'm on it yet, but I've put together the application to join the Welland Downtown Business Improvement Areas Board of Directors. So not official yet, but I've put the application in, and I'm pretty confident. I think
Feeling good.
I'm feeling good about it. I think they're gonna take me. I'm excited. I'm excited. I've never done something like this before. It's a little more political. I'm interested. I'm excited though. I think there's going to be something good to come from it.
Well,
And like I said, I think the theme of this podcast is I'm Mr. Welland. I love it. If I can do anything to help Welland's downtown clean up and fix up, I'm in. Let's go. I want to do it. I want to see it happen. So.
All right. Well, maybe we'll have to reconvene after you've been on the board.
Can I make a suggestion? I want to be the first 2-time guest.
We'll do something good in the next year then. Okay.
I might be able to. I hope, and then we'll find something new to talk about. But I would gladly do it again. This is fun, guys.